It will be chaos. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a bank CEO urges immediate action, telling the government it must stop doing this now or risk all-out chaos. I'll show you why the CEO is so concerned and that needs the government to stop doing this or risk sending the entire U.S. economy into a deep recession. And with that, let's head over to Forbes, where we picked today's story up with a headline: Bank of America CEO Brian Moynihan warns Jerome Powell, you need to be mindful of relying on consumers to prop up the economy because they're beginning to burn out. And why does Bank of America matter here? Because they have some very deep and accurate credit card data. They know at any time the pulse of the U.S. consumer. And what do we continue to hear from Fed Chair Jerome Powell is the U.S. economy is strong, and it's on the back of a robust labor market where there's continued demand for U.S. workers and that wages continue to increase. But what we're finding out is just the opposite is happening, that perhaps the U.S. economy, as Brian Moynihan's making the case, is on the tipping point of a massive recession. And if the Fed doesn't act now, well, it's going to be far too late. In fact, we even heard Jerome Powell say that's their biggest risk, and for good reason. As we look and see advanced retail sales, we'll show you in blue what Bank of America is so concerned about, and this against the personal savings rate. Now, we heard back during the pandemic, and we knew this, that Americans had this large savings, and we continue to see over time that particularly lower income people have spent through that, and slowly this money is exiting the economy. And now what we can see is a big turn down in the personal savings rate, again, as it heads back to what are historically low levels, as consumers are still not keeping up with inflation. This is a problem because, of course, the banks know this, money's going out, and when the savings rate goes down, as you can see here in red, well, it usually leads advanced retail sales going down. And that's a big problem because consumers, of course, still want to spend. They love to spend, but the challenge is if the economy is slowing and they don't have the income, well, they turn to credit. And the banks, like Bank of America, continue to tighten lending standards. Here we see the net percentage of domestic banks tightening standards for credit cards against advanced retail sales. So if consumers can't get increases in their credit lines or new credit cards, well, that usually does not bode well for the retail sales data. Here you can see in the dot-com bubble, and after that, well, retail sales languished against tighter credit standards. During the global financial crisis, retail sales outright crashed as banks curtailed their lending activity, and now we know the standards remain fairly tight, and that's having an impact on sales. And again, you talk about what Brian Moynihan's worried about. You could also add on the fact that paychecks are shrinking here as average weekly hours of production of non-supervisory employees is now flatlining after a big drop post-pandemic. And you can see in the past against advanced retail sales, as hours worked gets trimmed, well, that means, of course, workers spend less money in the economy. And when they spend less money, well, that does not bode well in terms of the labor market that everyone is banking the U.S. economy on. As you can see here, as sales slow down, well, what do employers do? Well, they start to trim expenses. And in a high inflation environment, there is only so much they can do with their fixed expenses. And one thing they can cut if they don't have consumers walking in their store, well, that's employees. Here you can see continued claims rising in red against advanced retail sales. You notice as more people get on unemployment, they have less income, and that less income means, of course, they spend less. And we know that over time, there's 1.8 million people on unemployment where it was bound to have an effect on the economy. And I think what Bank of America here is now worried about, as we hear from the CEO, is that, look, this madness needs to stop. The Fed needs to start cutting rates here in a big way. And the stakes are high for Fed officials as we turn to the Wall Street Journal, who are trying to navigate two risks. One is if they ease too soon, allowing inflation to become entrenched at a level above 2%. The other is that they move too slowly. This is what Brian Moynihan's worried about, and the economy crumples under the weight of higher rates, suggesting that perhaps what he's seen in the data from his banks is that we are at a transitional period, that if the Fed doesn't start cutting, that means the U.S. economy is headed lower. But not to worry, if you're concerned, you can still make money in this economy, in this market. I'll show you how. Here's an update on some of our top trades from our reports over the last month. Here you can see, look at these big returns. Can you imagine in a month making 10% return or 12%, even 3% is huge. You do that month after month. Now you might wonder, is that really real? Let's take a look at GDX. We put two signals out here, one down here, and now it's raced higher. Of course, we'll have an update on all of our trades back on the Sunday show, sitting at a wonderful level of support. Most people would have never traded those levels because of the risk, but we show you some things that other people don't do. One, we have a report that looks at how the machine's positioned, and these things trade hundreds of billions of dollars. But one thing we do is we look at the history, we run that historical overlay, we show you when they're wrong and machines are starting to buy, and lo and behold, that huge returns for our clients on that. The other one is in a tactical report. Many of you like to trade these things, the RSI, the MACDs, and what do? You get in late, you get out early, you're bouncing around. We smooth that out with an additional indicator. You pair the two together with a 30-day free trial. Why do we do that? Because with a 3% return, you could pay for your reports for years. In fact, I got an email the other day, a new subscriber. He put 2 trades in, and within a couple weeks paid for multiple years of subscription. One trade, and you can do that too. Linked in the description below, because as we look at the economy, we talk about what Bank of America is worried about. Look at this. Lululemon sinks 15% on slower U.S. store traffic and weaker outlook. Now that doesn't make sense, because if the Fed is telling us we're in a no landing or soft landing scenario, well, we shouldn't see things like this. And look what they're noting. Visits to U.S. stores slowed at the beginning of the year, and shoppers bought slightly less than a year earlier. In fact, American consumers are, quote, a little soft coming into the year, he said. This from the CEO. As the U.S. traffic slowdown has been across the board, the company said, and wasn't particular to any specific category. So you're seeing a broad-based slowdown in demand. Of course, this would show up in the Bank of America's data as they look at it. Bank accounts, savings, credit card usage, it's all there. They've got it. But how about this? Olive Garden owner Darden seeing lower income diners spend less. And we know that when the economy slows down, one of the hardest hit economic classes is, of course, lower income. They're the ones that get their hours cut the first. They're the ones that tend to lose their jobs the first. It hits them in a big way. And now notice here you see low and middle income consumers have been hurt. It says, high credit card balances and delinquencies. Meanwhile, high-end consumers have been bolstered. Of course, Darden plans to continue pricing below inflation. We'll see how long they can do that to keep drawing customers, but will stop short of becoming a heavily promotional brand. That is, until it needs to, because we're at the beginning phases here, and that's the key thing. The longer you see people on unemployment, the less spending power they have, and it starts to backfeed into the economy. And this is exactly what Brian Moynihan's worried about. He's trying to tell the Fed, look, you've done it, you made it, you did it. Time to cut, because if you continue down this path, what you're going to do is tip the U.S. economy into recession, as you've done every single hiking cycle in the history of central banking. Even Nike, whose company everybody likes to buy their stuff is losing fans on Wall Street. But why? Weak sales pressure stock. The world's largest sportswear company has lost more than 40% of its value, and it's struggling with the same headwinds as other consumer-linked stocks as shoppers curb their spending in the face of elevated borrowing costs. You talk about who could fix that problem and fix it in a quick way. That would be the Federal Reserve, but we know Jerome Powell doesn't want to. He's so concerned about inflation that he wants to hold rates here. The risk is, if he continues down this path, we are in big trouble. Even Circle K owners' shares plunge as earnings are missing estimates. And look at this, diesel demand continues to be weak, and that's a leading indicator of some softness in some sectors of the economy. And so that means that consumers are driving less, they're ordering less. That means, of course, there's less transportation, less usage of energy. Never a good sign. You want to see an economic expansion? Energy usage goes up. Contraction goes down. Merchandise revenue per store, such as food and cigarettes, dropped in all three of the company's geographic segments for the first time in more than 10 years. Of course, that means since the last recession, not a good indicator here at all. In fact, 7-Eleven's decline was even worse, which is reassuring and suggests industry-wide weakness. That is not a good sign for the economy at all. And even Walmart, who usually does really well with low-income consumers, particularly during times of recession, even they're starting to struggle. Why? Because now they want to get high-end consumers in, hopefully under the idea that they'll like Walmart stores and do some other shopping there. And guess what? They're finding out that higher-income people are showing up, as Walmart's trying to lure wealthy shoppers with blazers and duck breasts, as higher-income customers have been increasingly drawn to Walmart as inflation has risen in the U.S. Why is that? Because even they're getting squeezed in this economy. That means they're looking to save some money, and Walmart, of course, that's a place to do it. So they're headed there, as households making more than $100,000 a year were key contributors to the firm's latest quarter, as their purchases of general merchandise like clothes and toys drove a whopping 2/3 of market share gains. Of course, that means taking away from other retailers, and that means people are actually ordering fewer things online, and that has a big impact. Companies like FedEx. And here we see FedEx tightening 2024 profit forecast on cost cuts. Now, of course, when a company talks about cutting costs, that means they are struggling, because if demand for their product was rising and business was booming, they wouldn't worry about cutting costs. In this case, FedEx is seeing a slowdown, and sure enough, the company's express overnight delivery unit has been struggling with falling volumes. That means demand for shipping is dropping, demand for consumer goods is falling, particularly as the United States Postal Service shifts packages from higher margin air services to more economical ground services. Why would the post office be doing that? Because demand is falling, and they too need to cut expenses and say, hey, you know what? People can wait an extra couple of days. We're not putting this by air, we're putting it by ground, and that is having an impact. So you start to look around the U.S. economy and you see a broad-based slowdown. It's not just the U.S. We look to our partners up north. In Canada, retail sales rise a mere 0.1% after a big January decline. In fact, receipts for retailers rose 0.1% last month, following a 0.3% drop in January, the biggest such drop since March of 2023. That is huge. In volume terms, retail sales increased a mere 0.2% that month. Now, of course, we know that even in recessions, it does tend to be a little bit unusual, unless you get into all financial crisis, that you see a contraction in retail sales. It does happen, but mainly that's because people still need to buy stuff and prices are higher. That factors, but overall, today's data shows that consumer spending is still struggling to grow in a higher interest rate world, but is not collapsing. Well, at least not yet, but based on what we're seeing in the warning from Brian Moynihan, we're getting there. And then we turn to Germany, a country that is mired in a manufacturing depression, and things there are getting worse. You start to look around the world and you start to wonder, is this no landing, soft landing scenario that the U.S. equity market seems to be pricing in reality? The answer is not even close. As downturn in German economy eases slightly in March, here we can note that the manufacturing PMI is still in contraction at 41.6. You're talking perhaps depression level data, only in a matter of this is going to get worse in a big way. In fact, the services sector is contracting at a slightly slower rate. But look at the inside the report. A sustained decline in inflows of work in March highlighted continued weakness. Now, this is new work, so this is new orders in demand across the German private sector. Surveyed businesses often remarked on customer hesitancy, attributing this in part to ongoing geopolitical tensions and high interest rates. Again, you talk about what could fix this. Again, look back to what Brian Moynihan was saying. Hey, look, government, Fed, you need to act now because we are at the tipping point. This is a dangerous game. And new orders in Germany collapsing against high interest rates. More positively, however, the rate at which new business fell was the weakest since June of last year, but it's still declining. The drag from falling new export business eased as well. And in a sign of underutilized capacity across the private sector, businesses reported a further reduction in outstanding business. So that means the existing order books that are already there is declining in a big way. What did we say happens when you run out of when your new order book shrinks down and your existing existing book of orders goes away, your backlogs, well, that means unemployment likely to rise. And the rate of depletion eased notably since February due to slower falls in both monitored sectors, although it remained marked overall. Manufacturing backlogs continue to fall particularly sharply, which in turn contributed to another round of factory job losses. There you have it. If further, albeit slower, rise in services sector workforce numbers provide some support to the labor market, notably those being lower paid jobs, but it wasn't enough to prevent a renewed decline in overall employment at the end of the first quarter. Look, the warning signs are here, my friends. The fact that Bank of America, that Brian Moynihan, the CEO, who has an impressive amount of data at his fingertips on a daily basis, is warning the Fed and saying, look, if you don't cut rates and cut rates soon, the U.S. economy is heading to recession. I think it's time that we start watching out. We're at the tipping point, and it's only likely to get worse from here. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.